Today is our first unit, corporate governance. Broadly, we have to discuss three divisions. One is what are the roles in government governance hierarchy, then internal control and enterprise risk management. And what we are going to discuss is the corporate governance, is the rule of policies, procedures, sets we have. Stakeholders are the person who are interested with the company somehow. And every company has to incorporate, they should have standard documents, article of association, memorandum, and share capital. And we were discussing that the governance has been divided into two portions. One is the administration, day-to-day operation. For that, head is called CEO, MD, Managing Director. And the owners, board of directors are picked by or chosen by the other shareholder in the meeting, annual general meeting. So this is the board of directors who make the overall vision of the company. For example, they are always thinking if they are in US, should they go to outside US, will they make expansion, will they contract? This is what board is deciding about. Surely information is coming from the CEO in terms of certain reports, but it is the board who is approving the policies, procedures for the company. So anywhere where the companies are internal audit department and there is a problem with the finance, there is some procedural issues. So the focal point is always a loose policies and procedures. In certain companies, internal auditor is not feeling more comfortable, more good. He identified certain things and he reported nothing happening, So this is not the fault of the internal audit or the other people. It's a system fault. They don't know the policies, procedures. It's a CEO fault. It's a fault of the board, in fact. So employees should not be frustrated in that case when they are not able to do any, and they are not able to bring change in the system. So I feel that, generally audit departments, they are more frustrated. They want to bring change, but they are unable to. So the issue is to the board itself, the owner who is setting the tone for the company. So board of directors, they are not directly into day-to-day business. And because this is management responsibility, who is headed by the CEO. Now, directors owe fiduciary duties. Fiduciary is a legal word, is a law language. It's a duty of faith. Because the directors, they are the topmost authority. This is the biggest level in the organization. They are all in all. And whatever decision they have to take, no one can challenge them. Because they have authority, they have a responsibility on themselves. And suppose there is a big companies has big cash with them. This cash you have to give it to an investment company for 2 years. Investment company owner is your brother. Right? But this company is good company. So such kind of situation which are questionable, but certainly they have the full discretion to go for it. That's why we can tell them that your investment decision should be independent, fair, there should be no connectivity in between. But still at the end of the day they have certain rights. If they get it the right way. If the investment company is owned by the wife of the, say, Procter & Gamble director, and this company is a good company, they are in contravention of a connected person clause, but still they have a capacity to justify their decisions. So their strategies are more principle based, more broader based. That's why director and officers owe a fiduciary duties to the corporation. What it includes, act in the best interest. You should take decisions which will be healthy for the company, not for you. This is one. Be loyal. This is, we have to tell them that directors should be loyal with the company, not with their persons first. They should keep company first priority, then the other people. Then they should use due diligence. Means they should be capable enough to take the decisions. Now, who are the officers? Executive management. Surely this is the CEO is directly selected, reported to the board of directors. CEO is appointed by the board of directors and it is reportable to him also. And then CEO in turn is going to create C-level executive, that is mainly CFO, that is Chief Financial Officer, and the CIO, that is Chief Information Officer. He can have other designations also to appropriate to run the show of the day-to-day operations. Now, once a CEO has to corporate governance, basic is not complete until you don't have internal audit function in your organization. Internal auditor and internal audit department should be formed in the as a best practice for the corporate governance, and an internal audit function is a crucial governance structure for any complex modern entity. And for that we have one institute of internal auditor, that is IIA, that is also in USA, and they have this degree called Certified Internal Auditor as well. But they give the guidelines to the internal audit activity, how it should be performed. They give more focus on standards. They have standards like performance standards, implementation standards. This is not here to be discussed, but just for your information I'm telling. Like we have international accounting standards, same we have international auditing standards, and for internal auditing we have our own standard, which is performance standard, attribute standards, which tells us that internal auditor should be fair, honest, impartial, and there should be a charter in a company which explains everything, that how the company will be monitored, what is allowed, what is not allowed, what is the policy, procedures, and then every internal sub-manuals mechanism will be there. Same way, the auditor should perform two things. One is assurance services, the other is consulting services. This will be defined in the charter, that generally assurance services is the compulsory part of the internal audit activity. Assurance is the giving endorsement that the procedure, policies, they are aligned and all management policies has been drafted and they are implemented and adherence is there. Assets are safeguarded and policies are implemented and efficiency is achieved. This is the internal audit main activity role. Consulting services is an optional thing of the activity. If management wants that internal auditor should work as a consultant as well, consultant for certain assignments. Internal audit is okay, but sometimes because internal auditor know the operations of the company very well, so management may involve him into a consulting advisory role. But this should be defined in the charter. If it is not defined in the charter, that auditor cannot give consultancy services, so internal audit activity will not be having the consultant internal auditor. Otherwise, this will be a part of this. But internal auditor should provide assurance services. Those where the internal audit function provide an assessment of the functioning of the governance, risk management, and control procedure. Shortly, this is GRC. This word is a short abbreviation, GRC, governance, risk, and control. All over the units we will talk about this GRC in discussion in detail.